Hey, wealth builders, welcome. Comment the country you're tuning in from. Let's see how global our squad really is. Imagine this. You've saved your entire life to live out your dreams and enjoy a peaceful retirement. After years of hard work, you're finally ready to enjoy your savings. But 5 years later, you have nothing left. This is the nightmare of thousands of retirees around the world. And for some, it's becoming a harsh reality. Let's take an example. In the United States, you have a retirement income of $1,800. But in 2023, inflation hit over 6%. The result? On those $1,800, you lost $108 in purchasing power. This is a loss that no retiree wants to experience in their daily life. Another example. Small investors bet on a company like Secure Tech, a leader in cybersecurity, but then a scandal hits and the company collapses. As a result, thousands of small investors lose a portion of their savings. These kind of stories are, unfortunately, all too common. Even worse, in recent months, several European countries have modified their pension systems. The pay-as-you-go system is showing signs of weakness, and the situation is even more worrying in some Eastern European countries. In short, even those who thought they had everything planned for their retirement find themselves having to revise their plans in the middle of their golden years. Today, I'm going to reveal 2 simple investment strategies that you can implement to secure your retirement and guarantee a stable, stress-free income. One strategy will help protect your capital, while the other will help it grow in a more aggressive manner. But before we dive in, make sure you're subscribed to the channel and hit the notification bell so you never miss a video. Now, let's talk about how to secure your savings. Modern retirees face 3 major fears. The first is depending entirely on the public pension. The second is watching their savings disappear in the face of a market crash. And the third is living too long, so much so that their capital runs out long before they die. And these fears are well-founded. The life expectancy for women in the United States is over 85 years, and 15% of retirees live on less than $1,200 per month. This is a reality, and many people find themselves without resources when they need them most. So, how can we avoid this? A good investment portfolio for retirement must meet 2 essential criteria. The first is to protect the capital from inflation and economic crises. The second is to ensure a regular, predictable income without risking the loss of your capital with every market downturn. But how do we achieve this goal without taking unnecessary risks? The answer is simple. Diversify your investments. And more importantly, choose assets that have proven their resilience over the years. One proven strategy is the permanent portfolio. It's based on a simple idea. The economy is unpredictable. Some periods are marked by strong growth, others by inflation, deflation, or crises. To weather these ups and downs, a portfolio must be flexible and well-diversified, capable of withstanding whatever comes its way. The permanent portfolio is divided into 4 equal parts: 25% in stocks, 25% in bonds, 25% in gold, and 25% in cash. The stocks are there to capture growth. The bonds provide stability. Gold protects you against inflation, and cash serves as a safety cushion. The stocks you choose should be solid and secure, like ETFs, exchange-traded funds, that track the largest, most stable companies worldwide. For example, the ETF with the code EUNL, which tracks the strongest companies in the Eurozone. As for gold, it should be physical, coins or bars, stored safely, rather than gold ETFs. Bonds are the cornerstone of stability. Invest in low-risk government bonds, such as U.S. Treasury bonds, which are rated AAA. This type of investment guarantees a steady income while protecting your capital. As for the cash component, it's not there to generate high returns, but to ensure that you're never forced to sell other assets at a loss during a crisis. Keep this portion in secure bank accounts or low-risk savings products. Between 1972 and 2022, the permanent portfolio generated an average annual return of 7 to 9%, with very low volatility. And this, while surviving the major crises of the last 40 years, 1987, 2000, 2008, and even the COVID-19 crisis of 2020. By using this strategy, you can withdraw between 2% and 3% per year without worrying about depleting your capital. This withdrawal rate is enough to live comfortably while keeping your capital intact. This strategy, while simple to implement, requires a reliable platform to invest in. I recommend Freedom 24, a secure platform regulated in Europe that allows you to invest in stocks, ETFs, and bonds with ease. Opening an account takes just a few minutes, and right now, if you open an account through a special link, you can receive up to 20 free shares. The link is in the description. In the next part, we'll explore another popular strategy in the United States, the 4% rule, also known as the Trinity Study. We'll see if it's more suited to your needs and how you can adopt it while balancing the risks. Let's take a closer look at the second strategy, the 4% rule, also known as the Trinity Study rule. This strategy is extremely popular among retirees in the United States because it offers a clear, straightforward way to ensure that you don't run out of money in retirement. The principle behind the 4% rule is simple and easy to remember. You invest your capital, and each year, you withdraw 4% of that capital to cover your living expenses. For example, if you have $500,000 in your portfolio, you would withdraw $20,000 each year. The beauty of this strategy lies in its simplicity and predictability. However, like all strategies, the 4% rule has its advantages and limitations. The biggest advantage is that it's been rigorously tested and proven to work in most market conditions. A study by Trinity University in the United States found that if you withdraw 4% annually from a diversified portfolio of stocks and bonds, you're very unlikely to run out of money during a 30-year retirement period. The study concluded that, based on historical data, retirees have a 95% chance of maintaining their savings while following this rule. But the 4% rule isn't without its risks. For one, the market doesn't always perform predictably, especially during long periods of economic downturn. In times of market crashes, you may be forced to sell stocks and bonds at a loss, depleting your portfolio faster than anticipated. Also, this strategy requires mental discipline. It's not easy to see your portfolio shrinking, even though you know that it's just a temporary setback. The trick is to stick to your withdrawal plan and avoid making emotional decisions during market volatility. Another limitation of the 4% rule is that it assumes a stable economic environment. It works well in countries with stable economies and relatively low inflation, such as the U.S. However, if you're in a country with high inflation or political instability, the 4% rule may not be as effective. For instance, in countries like Argentina or Venezuela, where inflation can soar well above 30% annually, your 4% withdrawal will be significantly reduced in real purchasing power. Therefore, if you live in a country with high inflation, the 4% rule may need to be adjusted, either by lowering your withdrawals or by having a larger portion of your portfolio in assets that are less sensitive to inflation, such as gold or inflation-protected bonds. Despite these limitations, the 4% rule is a great starting point for retirees who want to maintain a predictable income stream. The strategy is simple to follow and doesn't require constant monitoring or complex decisions. If you're someone who wants to retire without having to constantly worry about your finances, the 4% rule is a great option. So, what's the best way to implement the 4% rule? Well, just like the permanent portfolio, you'll want to build a diversified portfolio that includes stocks, bonds, and possibly some other assets. A good starting point is to invest 60% of your capital in stocks and 40% in bonds. The stock should ideally be in low-cost, broad market index funds, such as the S&P 500 or international ETFs that give you exposure to global growth. The bond portion should include government bonds or highly rated corporate bonds that pay a reliable income. For example, a great option in the U.S. market could be the Vanguard Total Stock Market ETF, VTI, 4 stocks, and the iShares iBoxx Dollar Investment Grade Corporate Bond ETF, LQD, 4 bonds. These ETFs provide broad exposure to the stock and bond markets, offering a good mix of growth and stability. The 4% rule isn't just for the U.S. You can implement it anywhere in the world. For instance, in the UK, you could invest in the iShares Core FTSE 100 ETF for stocks, which tracks the 100 largest companies in the UK, and the Vanguard UK Investment Grade Bond ETF for bonds. Both of these ETFs offer a diversified and low-cost way to build your retirement portfolio. If you're ready to start implementing the 4% rule, or any of the other strategies we've discussed, you'll need a reliable platform to buy these assets. I recommend using platforms like Freedom24, which offer a wide range of stocks, ETF, and bonds across different markets, with low fees and high security. Opening an account is simple, and you can start building your retirement portfolio right away. But before we dive into the next strategy, let's take a moment to consider the psychological aspect of investing for retirement. When it comes to retirement planning, we often focus so much on numbers, strategies, and percentages that we forget the most important factor: mindset. The psychology of money plays a huge role in determining your financial success, especially in retirement. Let's face it, investing can be stressful. You're putting your hard-earned money into assets that may rise or fall in value, and the uncertainty of the future can be overwhelming. This is especially true when it comes to planning for retirement. The fear of running out of money, outliving your savings, or facing a sudden market crash can create anxiety that keeps you up at night. But here's the thing. Your mindset about money and investing can either help you stay calm in tough times or drive you to make impulsive decisions that could hurt your long-term wealth. That's why it's crucial to develop a healthy relationship with money and adopt an investor's mindset. The first step in cultivating this mindset is to embrace the idea of long-term thinking. Investing for retirement is not about getting rich quick. It's about growing your wealth steadily over time and making sure that you have enough to support your lifestyle once you're no longer working. This requires patience, discipline, and the ability to tune out the noise of short-term market fluctuations. Many people panic when the market drops and sell their investments at a loss, thinking they can't afford to lose anymore. But experienced investors know that downturns are just a part of the cycle. Instead of selling, they see market dips as an opportunity to buy more assets at a discount, knowing that the market will eventually recover. For instance, if you had invested $10,000 in the S&P 500 during the 2008 financial crisis, you would have been down as much as 50% at the worst point. But if you held on and didn't panic, by 2020, that same investment would have grown to more than $40,000. That's the power of long-term thinking. But long-term thinking doesn't mean ignoring short-term needs. While it's important to stay focused on your retirement goals, it's also essential to keep some liquidity in your portfolio for emergencies. This is where the balance between the permanent portfolio and the 4% rule comes into play. The permanent portfolio provides stability, while the 4% rule offers flexibility to withdraw income as needed. Now, let's talk about one of the most powerful concepts in investing: compound interest. Compound interest is often called the eighth wonder of the world because of its ability to turn small investments into large sums over time. By reinvesting your dividends and interest, you allow your wealth to grow exponentially, making your money work for you while you sleep. If you start investing at a young age, the impact of compound interest is even more significant. For example, let's say you invest $5,000 a year for 30 years in a diversified portfolio that earns an average return of 7% per year. At the end of 30 years, your investment would grow to over $500,000, not because of your contributions, but because of the power of compounding. The key to making compound interest work in your favor is time. The longer your money has to grow, the more powerful compounding becomes. Even if you can only invest a small amount at first, it's crucial to start as soon as possible. Consistency is far more important than trying to time a market or waiting for the perfect moment. However, while compound interest is a powerful tool, it's important to remember that not all investments are created equal. You want to make sure that your investments are in high-quality assets that will stand the test of time. This is why the permanent portfolio strategy is so effective. It ensures that your money is spread across assets that have a proven track record of resilience, such as stocks, bonds, gold, and cash. Now, let's shift gears and talk about a hybrid strategy that I've personally found to be the most effective for balancing growth and stability. This strategy combines elements of both the permanent portfolio and the 4% rule, creating a diversified approach that offers both safety and income generation. In this hybrid strategy, you allocate 30% of your portfolio to cash and bonds. The cash portion should be held in secure bank accounts or short-term deposits, while the bond portion can be invested in government bonds or high-quality corporate bonds. These assets provide stability and liquidity, allowing you to weather any economic storm. Next, You allocate 40% to dividend-paying stocks. These stocks should be from solid companies with a history of paying consistent and growing dividends. For example, you can invest in dividend aristocrats like Johnson & Johnson, Procter & Gamble, or Coca-Cola. These companies have consistently increased their dividends for decades, making them reliable sources of income. The remaining 30% of your portfolio should be invested in global ETFs that provide exposure to long-term growth. These ETFs track major indices like the S&P 500, the MSCI World Index, or emerging markets. By investing in global ETFs, you ensure that your portfolio benefits from the growth of both developed and developing markets around the world. Finally, to protect against inflation and geopolitical risk, you should include 10% of your portfolio in physical gold. Gold is a hedge against inflation and a safe haven asset during times of crisis. Rather than investing in gold ETFs, I recommend buying physical gold in the form of coins or bars, which you can store safely in a secure location. This hybrid strategy provides the best of both worlds. It offers you stability of bonds and cash, the income-generating power of dividends, the growth potential of global ETFs, and protection of gold. And the beauty of this strategy is that it's simple to implement and requires minimal maintenance. As we wrap up, let's put everything together and talk about how you can implement these strategies for financial freedom. At the end of the day, it's not just about investing. It's about creating a plan that works for you, a plan that gives you peace of mind, knowing that your retirement is secured and your wealth is steadily growing. The strategies we've covered, the permanent portfolio, the 4% rule, and the hybrid strategy, are all designed to protect your capital, generate income, and give you the flexibility to adapt to changing circumstances. But the real key to success lies in action. It's one thing to know about these strategies, but it's another thing entirely to take that first step. Start small if you need to. Even if you can only invest $100 or $200 per month, it's better to begin now than wait until you feel you have more. The earlier you start, the more time your investments have to grow. Remember, the most successful investors aren't those who chase after the next hot stock or try to time the market perfectly. They're the ones who stick to a disciplined, long-term strategy, and they remain calm during market fluctuations. By keeping your emotions in check and sticking to your plan, you can build a stable financial future, no matter what happens in the economy. Another important aspect of investing is financial education. The more you understand about how the market works, how different assets perform, and how to build a diversified portfolio, the better equipped you'll be to make smart decisions. This is why I encourage you to keep learning, reading, and exploring different investment strategies. Your financial education is your most valuable asset. And don't forget to take advantage of the resources available to you. Platforms like Freedom24 make it easier than ever to invest in a variety of assets, from stocks and ETFs to bonds and precious metals. The tools are at your disposal, but it's up to you to use them wisely. Before we finish, I want to remind you that achieving financial independence is not a race. It's a journey. There will be ups and downs, but as long as you stay committed to your goals, diversify your investments, and stay patient, you'll eventually get to where you want to be. So what are you waiting for? Start implementing these strategies today. Take control of your financial future, and don't let uncertainty dictate your retirement plans. The sooner you start, the better off you'll be in the long run. Thank you for watching. If you found this video helpful, please hit the like button, share it with someone who needs to hear this, and drop a comment with your thoughts. If you're ready to take the next step in securing your financial future, consider subscribing to the channel and turning on the notification bell so you never miss an update. Remember, your money can work for you while you sleep. The key is to be patient, strategic, and disciplined. Thanks for watching, and I'll see you in the next video. Don't forget to subscribe if you want your money to work for you while you sleep.